March 26, 2021, Wall Street witnesses something it had never seen before. Billions of dollars begin evaporating across global markets, not slowly, but in minutes. Stock of many companies are collapsing. Banks scramble trying to understand what is happening. Goldman Sachs, Morgan Stanley, Credit Suisse are all blindsided. And at the center of this chaos, hidden behind layers of swaps, is one man. A quiet, soft-spoken immigrant named Bill Hwang, a man with no public profile, no interviews, and no visible hedge fund. He didn't run a Wall Street giant. He didn't manage billions for clients. He didn't appear on a single shareholder list. And yet, he controlled over $100 billion in secret stock bets. How did he do it? How did one person, working in secret, nearly destabilize the global financial system? 1992. Bill Hwang, a quiet Korean immigrant, is studying economics and finance in New York, but something about him is different. While everyone else is buried in textbooks, Bill is spending his free time tracking the markets. He isn't guessing or following hype. He's studying how prices move, how investors react, and how trends form in small dorm rooms and quiet corners of New York libraries. Bill Hwang is sharpening the skill that will one day make him a legend. By the mid-1990s, his talent leads him to one of the most legendary hedge funds ever created, Tiger Management, which is led by Julian Robertson. The Tiger King of Wall Street, is known for his strict standards, sharp instincts, and almost military discipline. He rejects 99 out of 100 people who tried to work for him, but Bill slips through the door. At first, he's just another analyst, quiet, disciplined, almost invisible in the office. He doesn't brag. He doesn't pitch wild ideas. He doesn't fight for attention. He just sits back, watches the markets, and reads everything he can. But Julian Robertson starts noticing something unusual. Bill barely speaks, but when he does, it's precise. He'll point out a Korean stock that's priced wrong, or mention a small shift in Asian tech companies, or highlight a trend buried in the numbers that everyone else overlooked. And time after time, he was right. Analysts who had been on Wall Street for decades are shocked at how precise his calls are. Julian Robertson starts asking him more questions. Soon, he is invited into smaller meetings, then strategy sessions, then personal conversations. Bill is unnaturally calm, even under pressure. Colleagues joked, Bill doesn't trade like a hedge fund manager. He trades like a monk. And that isn't an exaggeration. He prays before trades, reads scripture every morning, gives money quietly to churches and charities without anyone knowing. To him, the markets are a kind of spiritual field, a place where discipline mattered more than emotion, and his discipline paid off. In 2001, Julian Robertson does something he rarely did. He hands Bill the keys to his own fund. Tiger Asia Management. A large, powerful Asia-focused hedge fund, a place where Bill can run his own portfolio and prove himself on a global stage. And he does. But how does a quiet immigrant go from managing millions to controlling billions? With Julian Robertson's blessing, Bill launches Tiger Asia Management, a new hedge fund focused entirely on Asian equities, a region that most American investors barely understood. It starts with a few $100 million, but within months, money pours in. 2007, Tiger Asia becomes one of the largest Asia-focused funds on the planet, managing over $5 billion. Bill becomes a legend in emerging market circles. He isn't just investing, he is forecasting, seeing shifts in technology, banks, and consumer behavior before anyone else noticed. He bets big on Korean internet companies. And he is early. He bets big on Chinese banks. And he is early. He bets big on the rise of Asia's middle class, and once again, early. He travels constantly. Hong Kong, Seoul, Beijing, Singapore. Sometimes visits 3 countries in a week. He meets CEOs, government officials, analysts. He builds relationships across Asia that even veteran investors envied. The same quiet talent he had at Tiger Management is now backed by billions. His colleagues describe him with admiration. They say, Bill doesn't trade like a hedge fund manager. He trades like someone seeing the future. But every rise creates pressure, and every empire attracts attention. Then came 2008, the chaos of the financial crisis. Regulators around the world begin tightening their grip on hedge funds, especially those trading across borders, and slowly they begin to notice Tiger Asia. Not because the fund is losing money, not because it is reckless, but because its trades are too accurate, too well-timed, too profitable, especially in Chinese bank stocks, a sector heavily influenced by government announcements and insider information. 2010, US regulators start digging. They suspect that Bill and Tiger Asia is receiving confidential information about upcoming share placements in Chinese banks and uses that information to profit. So they examine every trade under a microscope. And inside Tiger Asia, tension starts to grow. Is the information really insider knowledge, or are regulators simply misunderstanding the deep networks Tiger Asia had built in Asia? No one knows. But Bill Hwang doesn't panic. He keeps working, keeps trading, but the investigation doesn't go away. 2012, the US Securities and Exchange Commission finally moves. They charge Tiger Asia with insider trading and manipulation. The headlines are brutal. Tiger Asia accused of insider trading. Bill Hwang under scrutiny. Another Tiger Cub falls. But here's the twist. Bill Hwang never admits guilt. He doesn't confess. He doesn't fight the charges in court either. He chooses to live to fight another day. So he agrees to pay fines. He agrees to return the profits, and he agrees to shut down Tiger Asia as a hedge fund. It is a strategic choice, not a confession. Because legally, this allows him to move on without admitting wrongdoing, and with one signature, Bill Hwang walks away from the hedge fund world. To Wall Street, the message is clear. Bill Hwang is finished, a man once trusted with billions. Now barred from managing outside money, his reputation shatters. His hedge fund career erases, or so the world thought. But Bill will soon discover a new loophole, one that would allow him to rebuild an empire bigger than anything he managed before. What loophole is this, and how can it let him trade billions in secret? Archegos, the hidden empire. But here's what the world doesn't realize. Bill isn't thinking about retirement or disappearing, or giving up trading forever. 2013, after dissolving Tiger Asia, Bill creates Archegos Capital Management. But here's the secret. Archegos isn't a hedge fund. Instead, Bill has studied something new, something unusual, something the financial world barely pays attention to. A little-known structure called a family office, a private investment shop built only to manage Bill's own wealth. Family office is so small that there is no regulatory oversight, no public reporting, and no transparency. A loophole big enough to rebuild an empire in total secrecy, while most people use family offices to manage inheritance. Bill sees something different, a way to trade again, a way to use leverage again, a way to build something even bigger than Tiger Asia, without regulators watching. Instead of buying stocks the normal way, Bill turns to something exotic. Total return swaps, or TRS. A TRS is like renting a stock instead of buying it. But you get all the gains, all the losses, all the dividends. The most important thing is the stock never shows up under your name. It stays on the bank's books. This means Bill can secretly control huge chunks of companies, without the public or even the companies themselves knowing, and because swaps requires only a small upfront deposit, banks like Morgan Stanley, Credit Suisse, Nomura, UBS, Deutsche Bank are happy to lend him massive leverage. Then Bill starts turning every dollar into 5, sometimes 8, sometimes even more. And the bank smiles because he has a clean record, years of experience, and billions of his own money. Using swaps, Bill secretly builds enormous positions in companies like Viacom CBS, Discovery, GSX, Baidu, and Tencent Music. He doesn't just own 5% of these companies, he owns exposure equal to 20%, 30%, even 50% of their float, without a single disclosure. Internally, banks guess that he was managing $10 billion, maybe $15 billion, but the truth? Regulators later estimated his hidden exposure at nearly $100 billion, a giant made of leverage. An empire built on borrowed money, a position so large that even tiny market tremors could shake the entire structure. But what could trigger such a giant to collapse? The first crack. 2021. Archegos is riding high, media stocks are soaring. Bill's bets are paying off. Banks are happy. Margins look safe. But hidden empires rarely explode in one moment. Collapse usually begins with something small, something nobody thinks will matter. For Archegos, that moment arrives on March 22, 2021. Viacom CBS, one of Bill's largest, most aggressively leveraged positions, announces something routine, a stock offering. They want to raise money by issuing more shares. Normally, a small dip, a mild reaction, nothing dramatic. But for Bill, this is the spark in a room filled with gasoline. The slide begins. The moment the offering is announced, Viacom CBS slips, then slips even more, then begins a free fall. A drop of 5% becomes 10%, then 15%. For an ordinary investor, it is uncomfortable but survivable. Because Bill is so heavily leveraged, even a small drop creates a margin call. But on the way down, those banks want protection. They want collateral. They want cash, immediately. Morgan Stanley calls. Credit Suisse calls. Nomura calls. All the banks he borrowed money from calls. And Bill repeats the same answer. I just need time. But time was the one thing he no longer have. As Viacom CBS keeps falling, each bank becomes nervous. They are asking, why isn't Bill posting enough collateral? Why is every bank calling at the same time? Then the horror clicks for them. They realized they aren't the only lender, every bank that thought they were special, that thought Bill was only borrowing from them, suddenly realizes the truth. Bill has borrowed from all of them, no one has the full picture. Bill's true exposure had been invisible for years. Swap by swap, loan by loan, position by position. He has built an empire that no single bank understood. Here's the nightmare scenario. When one bank calls for collateral, that's bad. When every bank calls at the same time, that's fatal, because they all want the same thing, cash, immediately. And Bill doesn't have enough to satisfy even one of them, let alone all. Banks begin to whisper internally. They began asking, what if we're the last bank to act? Because in a crisis like this, being last means taking the biggest losses. And then comes the question that turned fear into panic. What happens if every bank tries to escape at the same time? Because when billions in leveraged positions hit the market at once, the entire structure will not just crack, it would explode. The Meltdown, March 26, 2021. The day everything explodes. By the early morning hours, the world of finance is waking up to a storm, one that would move faster than anyone can anticipate. Banks has already realized the truth. Bill Hwang's Archegos empire is over-leveraged, unstable, and ready to collapse. The first to act are Goldman Sachs and Morgan Stanley. Without hesitation, they begin dumping billions of stock of Viacom CBS, Discovery, Baidu, every position Bill had quietly built over years. The sell-off is sudden. Orders floods the market. The stocks plunges as prices crumbled under the weight of massive forced selling. Other banks, Credit Suisse, UBS, Nomura, hesitated. They hope prices would stabilize. They hope they can minimize their losses. But in the high-stakes world of leverage, hesitation is deadly. By mid-morning, the market has realized. This isn't just one bank selling. This is all of Bill's positions hitting the market at once. Panic sets in. The hidden empire that no regulator, no investor, and no bank fully understood is unraveling in real time. The numbers are staggering. By the close of the day, the losses are historic. Credit Suisse lost $5.5 billion. Nomura lost $2.9 billion. UBS lost $861 million. Morgan Stanley lost $911 million. And these are just the direct bank losses. Across the market, over $100 billion in market value vanished in days. Stocks that had once been quietly controlled by a single man now collapsed, dragging down shareholders and shaking confidence across global markets. Archegos vaporizes. In less than 48 hours, Bill Hwang's empire, years in the making, is gone. An empire that had seemed invisible, unstoppable, and untouchable, vanished overnight. But how far would the fallout go? Would anyone face consequences? The aftermath. When Archegos collapses, the shockwaves doesn't end with the $100 billion erased from the market. In fact, the real chaos begins after the meltdown. Regulators across the US, Europe, and Asia suddenly find themselves staring at the same impossible question. How did one private investor nearly destabilize the global financial system without anyone noticing? So they begin digging. Piece by piece, investigators uncovered a system full of cracks. Archegos has almost no oversight. Since it is a family office, multiple banks ignored their own risk warnings. Total return swaps hid everything. Leverage levels were off the charts, and worst of all, no bank knew what the others were lending. It wasn't just a failure of regulation, It was a failure of imagination. A year later, US federal prosecutors charges Bill Hwang and his CFO with fraud, market manipulation, racketeering, and artificially inflating stock prices. If convicted, Bill will face decades in prison. But Bill fought back. He insists, "I never meant to deceive anyone. I wasn't committing fraud. I was just aggressive." To him, it isn't a crime. It is just high-conviction investing. Prosecutors, banks, and regulators doesn't agree. Meanwhile, the banks paid the price risk departments are gutted, executives are fired. The collapse didn't just destroy Archegos, it exposed a system-wide blind spot in global finance. Today, Archegos is gone. Bill Hwang's trial is ongoing. Banks have tightened their risk rules. Regulators have cracked down on total return swaps, but the financial hole it left behind reveals a darker truth. Wall Street's most dangerous risks are often the ones no one can see, because Archegos didn't just collapse. It exposed the biggest blind spot of modern finance. One man with enough leverage can quietly destabilize the entire system. If you like this video, make sure to subscribe, where we will be uncovering more story like this. Until then, stay safe.